One of the questions people ask me so often is, how do I get started in investment? And actually, they then narrow that down, and the particular point they're really trying to address is, what do I need to know in order to be a good investor? Now, that's a really great question. So over the course of this video, I'm going to address the 5 key things I think you need to know to be a great investor. I spent 30 years in financial markets, in investment banking, asset management, and managing my own money. And in my opinion, these are the 5 things that if you can master, they'll set you on the right process to making money. So here's the 5. In my opinion, these are the 5 things you need to master. This is the minimal requirement. There's lots of other things you're going to need to know about over time, but these are the basic things which you need to master in order to maximize your chances of making money and not frittering your savings away. So we're going to go through all 5 one by one. Let's start with the first of them, which is about collecting data and knowing what's going on in the economy, the markets, and with respect to company reports. So let's dive into that one into some more detail. You need to know what's happening in the broader economy. Now, maybe you've decided to restrict your investments to one economy, perhaps the US, or maybe you've decided that you're a global investor and you want to invest in any number of countries. Either way, you can't escape knowing about the macroeconomic developments. Now, really, there's 2 ways of finding this out. One, you can read it in the financial press. That's not great because you'll be reading everything a day late. And of course, the financial press tend to focus upon issues which they think are going to sell stories rather than issues which impact your portfolio. So one piece I always give potential investors is this: find sources of information about the economies which you invest in, where you can get that information on a regular and systematic basis. And look at it every day. The economic data comes out pretty much on any weekday, and most countries have a regular schedule for the information coming out. Look and see what's on the schedule, look and see when it's coming out, and when the information is released, think about what you've seen. I think that's really important, rather than waiting until the end of the month or the end of the quarter and then sort of assessing where we are. It's much better to have a picture in your mind which is evolving over time about the economic conditions in which you're investing. So that's the first thing, where you want to collect data, and I do advise you, if you can't store it in your mind, keep some notes on bits of paper or on your computer, because I think it's really helpful to go back and think, this is what we were thinking last week, this is how circumstances have changed because the data's changed. Now, another thing you need to know about is the details of the companies you might invest in. This data is easily available because most companies have a quarterly reporting schedule. And again, you have access to the calendar and you can see when the companies are going to be reporting. Now, some companies, of course, you have made no interest in investing in which case you don't need to concern yourself with those. But there are 2 groups where I would concern myself. Firstly, those which you already own or you think you might buy, and the second group where the information they're giving is relevant to the whole economy and possibly the rest of your portfolio. So the type of company that falls in the second group are often bank results or the large institutional asset managers. if you get a sense of what they're thinking, that will really serve you well in terms of managing your own portfolio. Now, the last thing you want to know about is price action. What I mean by that is the graphs of how the market or the individual stocks are moving. There's a whole science behind this, but it's really important that you can see this data visually and you get a sense in your own minds of whether the market is rallying or whether it's selling off, rather than just looking at individual numbers. Graphs are much more powerful for that. So I do strongly advise you, try and subscribe to one of those services which gives you a picture of what the markets and the stocks are doing. This will be really helpful for you. Now, the second thing you need to know is what you own. Now, of course, that sounds self-evident. I think most investors say, of course I know what I own. I've got the brokerage account and the broker tells me on a monthly report what it is I've got. Frankly, that's not enough. I strongly advise you to create a spreadsheet, and on the spreadsheet you log all the positions you've got. Firstly, you may have more than one brokerage account and you want to consolidate everything in a single place. And the second thing, which I think is much more relevant, is that you need to know the risks you're taking in your portfolio. So you should be able to say on any one day, this percentage of my portfolio is in Japanese stocks, this percentage is in German stocks. Or you should be able to say, for example, by sector, this is my exposure to the automotive industry, this is my exposure to banks or to financials. So you'll need information you can't necessarily get easily from your broker, or where your broker produces this on a quarterly or an annual basis. You need this information every day, because as soon as you want to trade, you need to know what your portfolio already is. So strongly advise you, get that on a spreadsheet, consolidate it across all your portfolios. Now, of course, you need to know a bit more than that. So one of the things I strongly advise figuring out is, if the market rises by 10%, how much is your portfolio going to rise? So if your portfolio is, say, 50% in equity, 40% in government bonds and 10% in cash, and the equity market goes up by, say, 30%, how much money do you think you'll make? If it drops by 30%, how much are you going to lose? So you should be able to get a clear sign from the various driving forces of your portfolio how it will respond to different economic circumstances. This is absolutely important because we don't all get our forecasts right, and therefore stress testing your portfolio is really important. If you want to learn more about stress testing your portfolio, have a look at my course. We go into things like this and how to construct your portfolio in much more detail. So I think, to summarise, the kind of information you need to be keeping is your exposure to countries, your exposure to currencies, your exposure to different sectors within the equity market, your exposure to different asset classes like property or equity, and what your total exposure is to financial markets. Another thing that's really important to understand is how investments work. So, for example, if you're running a portfolio of equity, do you fully understand how equity works? What happens when companies go bust? How the dividend stream works? The type of sectors you can invest in the equity market? Similarly, if you're buying government bonds, fixed income is a very technical asset class. Understanding coupons, maturities, all of these different technical elements will be key to you making the best of your portfolio. So I strongly advise you to research whether it's property, fixed income, equity, whatever the asset class, and really understand and delve into the detail of the mechanics of the asset class, not only in terms of the individual structures of particular instruments, but the type of products you can buy within this asset class. Great question which comes from retail investors, which is how do I manage the structured products or the complex products which I might be sold by my financial advisor? Now, it's not for me to tell you to avoid structured products. What I do say is, just for myself, I avoid anything I don't understand. And if it's very complex, I'm much less likely to understand it, and therefore I don't buy it. Many of the products which are targeted at retail investors do have a number of structures embedded within them. And what that means is you're not buying a straightforward product where you make money if the market goes up and you lose money if the market goes down. They often have structures whereby you participate in a certain part of the market's rally, or you have some downside protection if the market falls. Where you have a product like that, which I think is inherently more complicated, do think through how this will affect your own portfolio, whether that complexity is really adding value to you, and whether you really understand how it will perform under different market circumstances. I think it always pays to be cautious with complexity, and as I said, personally, I'm always minded to avoid it wherever possible, but certainly there are structured products out there which may be appropriate for you. Another thing you absolutely must do is know your tax position. Now, of course, any financial advisor is going to tell you that, and it seems self-evident, but it's important to delve into the detail on this one. Let me give you an example of one of the details which people tend to forget. Suppose you're a UK investor and you invest in US equity. Whether it's in a tax privileged account like an ISA or not, you will be paying 15% withholding tax on the dividends. Now, that's not great news, especially if you've got the funds in a tax privileged account, but you can't avoid it. Now, you may be able to recoup some of that against your UK tax bill if it's in a brokerage account, but you may not always be able to do that. Tax is one of the things which significantly affects the returns on our investments. So it's really important to model what your taxation will be and to take advantage of tax breaks when you can see them. Now, I spoke a bit earlier about knowing what you've got in your portfolio. When you actually log the value of your products in your portfolio, important to remember that return you should see must be the return net of tax. Don't ever be fooled into thinking that there are no taxes on your capital gains or that you can ignore them and therefore lull yourself into believing you're a better investor than you really are. Important when you calculate your returns at the end of every year to know what those returns are net of tax, because that'll help you plan your own finances, and it'll also ensure that you buy the products which meet your tax needs most efficiently. Now, sometimes that may mean buying equity which pays very low dividends and most of your return is through capital gain. For other people, they'll want high dividends rather than capital gain. Everyone's circumstances are different, but I do advise you, think this one through for yourself. It isn't enough just to be told by an advisor, but really have a clear understanding so when you're transacting, you know what you're doing. It's often the case that a large part of your portfolio is going to be managed by someone else. Maybe you've decided to buy mutual funds for the portion of your portfolio which is invested in Japan, for example, or you bought an ETF for investments in the US, or perhaps for your fixed income investments you decided to pay a mutual fund manager for that. That makes perfect sense and is a very good way to manage the parts of your portfolio where you don't feel confident with dealing with the nitty-gritty yourself. But an important thing to remember is when you're choosing those managers, you need to choose the best manager. In other words, you're still carrying out oversight on the people whose investments you're buying. So it's really important to delve into the detail and fully understand how different mutual funds are performing and how different investors manage. So have a look in some detail to really understand which funds typically outperform the rest of the pack, which funds have done well in recent years, and which ones are the laggards. You don't want to get involved in the laggards. You can easily see on the web which funds are the best performers. And of course, be very careful, because sometimes you get one which performs exceptionally well for 1 year, but prior to that it's performed really badly, and it may just be luck. So look at those which have consistent performance and try and understand whether the process the fund manager uses, to the extent they tell you about this, is something you feel comfortable with. So remember, you're responsible for the oversight of your own portfolio and which fund managers you choose. So those are the 5 things that I think you really want to master before you start to invest. Of course, there's lots of other information you'll need to know. Some of it's almost equally relevant, and I'll be putting more courses on YouTube over the coming weeks. Of course, if you want more detail, you can have a look at the paid courses, and the link to those is going to be coming up very soon. In the meantime, I hope you've enjoyed watching this course. I hope it's been really relevant for you. Do please click the like button, do please subscribe, and there will be more videos coming along soon. Thank you for watching.